Welcome to this investing series, which has only one goal for the next few years. I plan to have $500 each month in dividends passively from the $500 invested each month. And again, each time I will invest in front of you live to show you which stocks I buy, why I buy them, and also how I adapt to the market. So for the last month, my $2,400 portfolio went up. I own 20 stocks, which makes my portfolio well diversified. I own stocks in 8 different sectors, including healthcare, energy, consumer staples, financials, industrials, consumer discretionary, and information technology. And this month I received dividends from 3 companies. On February 15th, I received a dividend from Procter Gamble of €0.20 or $0.22. 2 days later, I received a dividend from Apple of €0.18 or $0.20. And finally, I received a dividend from Cat of €0.43 or $0.46, which brings our total dividend payout to €6.77 or $7.23. So let's continue this challenge with $500. Now I decided to divide it into 4 for the 4 stocks I will buy today. So $100 a stock and $200 for one special stock. Alright, the first company designs, develops and sells consumer electronics, software and online services. It is the biggest company in the world by market valuation, thanks to its CEO Tim Cook, who pushed it further. Of course, I'm talking about Apple. Apple is known for its innovative products like the iPhone, iPad and Mac computers. Apple is currently focusing on expanding its services business, which includes Apple Music, Apple TV+, Apple Arcades, and iCloud. And the company has been investing heavily in the development of augmented reality, which might be a big deal for Apple, along with its Apple Car. Apple has been paying out dividends continuously for more than 34 years now, and has consistently increased them, for a current dividend yield of 0.62%. Its net income increased by around 17% a year on average for the past 5 years, with a good increasing earnings per share of roughly 24% a year to reach 6.11 in 2022. Also impressive return on capital of roughly 40%. It has a 1.16 times more assets than liabilities, which is not the best, but still the ratio keeps getting better and better, so increasing assets. It has a good relatively high PE ratio of 25 when the average of the US technology sector is at around 26. So in short, a great company which is also buying back its own shares, currently trading at roughly 25 times its earnings. Alright, so the first company we said is Apple. Create a savings plan, monthly, beginning, we said €100 or $100, that's typically the same, create, fingerprints, and done. Alright, the second company is an American multinational energy company that is involved in every aspect of the oil and gas industry, like exploration, production, refining, and also marketing. It also operates in over 180 countries worldwide and is one of the largest oil companies in the world in terms of revenue and also market cap. Of course, I am talking about Chevron. Chevron has 2 operating segments, upstream and downstream. The upstream segment is responsible for exploration and extraction of crude oil and natural gas. The downstream segment is responsible for refining crude oil into different finished products such as gasoline, diesel, aviation fuel, etc. In 2022, the upstream segment represented roughly 26% of Chevron's total revenue, while the downstream segment represented around 74% for a total revenue of $246 billion. Chevron has been paying out dividends continuously for more than 33 years now and has consistently increased them for a current dividend yield of 3.54%. Despite the 2020 pandemic, gas prices, inflation, and supply chain problems through 2022, the company still shows strong net income and earnings per share. Its net income increased by around 400% a year on average for the past 5 years, with a good increasing earnings per share of roughly 8.13 in 2021. So Chevron is known for its oil and gas operations in the world, right? But as human investors, we know that this will be one day gone forever. So good news, Chevron has also been investing into clean energy sources like solar and wind power. Chevron also tries to develop technologies like a carbon capture storage tech that can capture the carbon dioxide emissions and store them underground. So even if the company continues to be mainly focused on oil and gas for now, it also tries to stay in the long-term game by investing in clean energy, and that's what we want as investors. Alright, second company is Chevron. Monthly, beginning of the month, 100, and we are done. Alright, the third company was founded 186 years ago in 1847, and it manufactures agricultural machinery, heavy equipment, forestry machinery, diesel engines, and lawn care equipment. And if you want one last hint, the company's slogan is "Nothing runs like a deer." Of course, I'm talking about Deere & Company, which is more commonly known as John Deere. First, the agricultural segments, so the production and sale of tractors, combines, sprayers, and planting and seeding equipment, which account for almost 60% of their total revenue. The financial services segment, so retail financing and leasing for their customers and dealers around the world, which represent 21% of their revenue. And the construction and forestry segment, so production and sale of loaders, excavators, harvesters, etc., which represent 19% of their revenue, for a total revenue of 52.5 billion. John Deere has been paying dividends continuously for more than 27 years now and has consistently increased them for a current dividend yield of 1.13%. Despite the 2020 pandemic, gas prices, inflation, and supply chain problems through 2022, the company still shows strong net income and earnings per share. Its net income increased by around 34% a year on average for the past 5 years, with a good increasing earnings per share of roughly 46% a year to reach almost 24 in 2022. Also, a good stable return on capital of roughly 9%, as well as a decreasing price-to-book ratio of 6, which still remains high. It has 1.40 times more assets than liabilities, which is not the best again, but still the ratio keeps getting better and better, so increasing assets. It has a good PE ratio of 15, when the average of this US machinery sector is at around 26. In short, a great company which is also buying back its own shares, currently trading at only 15 times its earnings. And what's next for the company? Well, John Deere made serious investments that can be summarized in 3 important points. First, precision agriculture, which uses sensors and data analytics and other fancy tools to optimize farming operations and improve yields. It also acquired Blue River technology, which blends computer vision and machine learning to precisely apply herbicides on the field. Then electric and autonomous vehicles that have been in development since roughly 2016 for automatic planting and spraying on the field. Finally, sustainable operations by achieving carbon neutrality by 2015. Alright, the third company is Deere & Company. Create a savings plan monthly, beginning, next, fingerprints, and there we go. And finally, we have a stock that does not really represent one single company. It holds 500 companies in the US. And you probably know it, at least by name. It is called the S&P 500. It is a basket of the 500 biggest US companies, and it historically performed well, around 10 to 12% annually on average. But we will not directly invest in the S&P 500, since it would take forever to buy each of the single 500 biggest US companies. Instead, we can buy the Vanguard 500 index fund. Same thing, it is an index fund that tracks the S&P 500. So if the S&P goes up by 1%, the Vanguard 500 will also go up by 1%. And it's brilliant because we only have to buy one stock that holds the 500 at once. It was created in 1976 by Jack Bogle, the founder of the Vanguard Group, who recently died. He was known and loved by Warren Buffett himself for his idea to allow millions of investors in the world to maximize their return to around 10% a year, while allowing the rest of the investors to do the same without compromising their return. So, how to invest in it? I found 2 good options. You can either invest on the Vanguard website, you can start investing with $1 only. It has the advantage to have very low fees. It says 0.03%, which is close to nothing for the 10% gains a year on average. Or you can buy the index fund directly from your favorite broker. And I use Trade Republic because I live in Europe, and that's what I will do today so that I can track everything smoothly. And the fourth stock is the S&P 500. So, create monthly 200, it's time, create, and there we go. And if you have enjoyed this format, feel free to check my other videos in this place right there, so that you can follow my investing journey from the beginning and how I got there. Feel free to leave a comment down below, subscribe if you want to see more, and as always, I will see you in the next one.